Bismillahirrahmanirrahim. My dear students, Assalamu alaikum and welcome to all in my virtual class. I am Shahjalal Ahmed Pial, lecturer in Finance and Banking, Milestone College, Uttara. I hope all are fine and well by the grace of Almighty Allah. Dear students, let's start the class. My dear students, today I am going to discuss the classifications of financial market. This is the chapter number 2, legal aspects of financial market in your finance, banking and insurance first part textbook. Today's learning outcomes. First, you would understand types of financial markets. Second, definition of financial money market, components of money market, definition of capital market, types of capital market, and component of capital markets. Dear students, this is the lecture number 2 in these chapters. Classifications of financial market. Financial markets is a marketplace where creations and trading of financial assets including shares, bonds, debentures, commodities, etc. take place is known as financial markets. Financial markets can be classified into mainly 2 categories. First one, capital market. Second one, money market. Capital market. Capital markets are venues where savings and investments are channeled between the suppliers who have capital and those who are in need of capital. Capital market is used to mean the market for long-term investments that have explicit or implicit claims to capital. Long-term investments refers to those investments whose locking period is greater than 1 year or more than 1 year. Capital market is a market where buyers and sellers engage in trade of financial securities like bonds, stocks, etc. The buying or selling is undertaken by participants such as individuals and institutions. Generally, this market trades mostly in long-term securities. Long-term securities means more than 1 year. Now, we'll see the classifications of capital market. Capital markets has 2 parts. First one, primary market, and second one, secondary market. In the primary market, new shares or securities issued sold to initial buyers, and the secondary markets issued securities are traded or securities previously issued are bought and sold in secondary market. Secondary markets issues and securities are second-hand. Secondary market has 2 parts. One, exchange traded market or stock market. Second, OTC market. Primary market. In a primary market, securities are created for the first time for investors to purchase. New securities are issued in this market through a stock exchange, enabling the government as well as companies to raise capital. Primary market is the financial market in which a security is first sold by the issuer and bought by investors before further changing bond hands or owner. New bonds and securities issued in the capital markets are issued by the primary market. Primary market is that it is related with the new issues. Whenever a company issues new shares or debentures, it is known as initial public offering or IPO. Components of primary markets. Public issue through prospectus. This term occurs when a company issues new securities through IPOs. Rights issues. Rights issues is for the existing shareholders to purchase additional new securities. Private placement. This term refers to gathering capital through selected investors. Preferentials allotment. Shares are allotted to the investor on a preference basis. Now, secondary market. The secondary market, also known as the aftermarket, is the market where previously issued financial instruments such as bonds and stocks are bought and sold. It is where investors sell to other investors. A secondary market is the market in which securities issued in the primary market are traded by market participants. So, secondary market is a place where issued securities are traded. Types of secondary markets. Secondary market can be classified into two categories. First, exchange traded market or stock market. Second one, over the counter or OTC market. Exchange traded market. Exchange traded market, also known as auction market, is a place where all the transactions are routed through a central source or exchange that is completely responsible for being the intermediary that connects buyers and sellers. Exchange refer to the exchange traded markets, which refers to a centralized and regulated financial market where securities, commodities, derivatives, etc. of listed companies are bought and sold between stock brokers and traders. Over the counter market or OTC market. OTC market refers to the process where securities are traded in an informal way that is not listed on a formal exchange. Under these securities that did not fulfill the requirements to have a listing on a standard Market exchange. Stock traded in OTC market are basically of smaller companies that cannot meet exchange requirements for formal exchange. An over-the-counter or OTC market is a decentralized market in which market participants trade stocks, commodities, currencies, or other instruments directly between two parties and without a central exchange or broker house. Over-the-counter markets do not have physical locations. Instead, trading is conducted electronically. Components of secondary market. Equity market. Equity market has ordinary share, preferred shares, as another debt market. It has bond, debentures, mutual funds, warrants, and forex market. Custom commodity derivatives market. Money market. The money market is an organized exchange market where participants can lend and borrow short-term, high-quality debt securities with average maturities of 1 year or less than 1 year. Money market basically refers to a section of the financial market where financial instruments with high liquidity and short-term maturity are traded. Money market has become a component of the financial market for buying and selling of securities of short-term maturities of 1 year or less, such as treasury bills and commercial papers. Money market instruments are short-term financing instruments aiming to increase the financial liquidity of businesses. Components of money market. Treasury bill. Treasury bill is a short-term investment issued through actions conducted by the Central Bank of Bangladesh on behalf of the government. Treasury bills are issued at a discount and the face value is paid at maturity with interest paid upfront. Commercial paper. Commercial paper is a commonly used type of unsecured short-term debt instrument issued by corporations, typically used for the financing of payroll, accounts payable, and inventories, and meeting other short-term liabilities. Maturities on commercial paper typically last 7 days and rarely range longer than 270 days. Commercial paper is usually issued at a discount from face value and reflects prevailing market's interest rates. Bankers' acceptance. One of the most common money market instruments traded in the financial sector. A banker's acceptance signifies a loan extended to the stipulated bank with a signed guarantee of repayment in the future. Certificate of deposits. A certificate of deposit is a type of money market instrument. A certificate of deposit is a type of savings account usually used by commercial banks which restricts your access to the money you invest but offers much higher interest rates than those associated with regular savings accounts. Repurchase agreement or repo. A repurchase agreement, also known as a repo loan, it is an instrument for raising short-term funds. With a repurchase agreement, financial institution essentially sell securities from someone else, usually a government, in an overnight transactions and agree to buy them back a higher price at later date. Commercial bill or bill of exchange. A commercial bill or bill of exchange is a short-term, negotiable, and self-liquidating money market instrument which evidence the liability to make a payment on a fixed date when goods are bought on credit. Call money. The interbank call money market is a short-term money market which allows for large financial institutions such as banks, mutual funds, and corporations to borrow and lend money at interbank rates. The rate of interest that banks charge when they borrow funds from each other. The loan in the call money market are very short, usually lasting no longer than a week, and are often used to help banks meet reserve requirements. Short-term commercial bank loan. A short-term loan is a type of loan that is obtained to support a temporary personal or business capital. As it is a type of credit, it involves a borrowed capital amount and interest that needs to be paid by a given due date, which is usually within a year from getting the loan. Dear students, thank you all to stay with me, and goodbye.